Congratulations, you have reached the executive ranks. Or maybe you're on your way and you're trying to plan ahead. With that aspirational title and increased responsibility often comes compensation that goes beyond a standard paycheck. I'm Patrice Sikora with Joe Patterson of Foster and Motley. It's good to have you here, Joe. Good to see you.
Thanks, Patrice. Happy to be back.
All right, now let's discuss the ins and outs of executive compensation and tips to help listeners make some better compensation decisions. Talk to me about compensation. What can executives look for?
Yeah, so let's sum it up with the popular phrase, more money, more problems. Um, when you make more money, you have more complications. And that's kind of executive comp in a nutshell. Is it's not as simple as I get my weekly or biweekly or monthly paycheck. It's not as simple as, hey, I even get a bonus at the end of the year. So with additional responsibilities comes additional compensation and additional complexities in that compensation. So why are we talking about this? A, because new things are worth planning for, and B, there are tax ramifications to that planning and how you get paid. And those are things that you want to be on top of when considering your compensation, because many times executives are presented with
Mhm.
different choices. And if you haven't come across those choices yet, knowing what they mean and knowing the impacts of those choices, both from a tax and an earnings perspective, can really be beneficial to you as you consider your future path in this new role.
All right, well, you're going to get your base compensation, and that would be, as you said, the weekly, the biweekly, the monthly paycheck, whatever it is. How do we tackle that?
Yeah, so that's the easiest part of it because typically that's a known number. Uh, like many roles, you probably will get that reviewed on a periodic basis, usually annually. Um, that's the fixed part, and really the idea with executive compensation in a nutshell is there's an opportunity to earn more income, but it also often comes tied to other metrics. And those other metrics are usually in some combination time and performance. So we can dig into those a little bit. You get your base compensation, right? That's your salary. Many executives still can participate in bonuses. Those bonuses could be paid in cash, they could be paid quarterly, they could be paid annually. Those still probably look similar to a bonus that you might have been familiar with previously, which is, hey, I met my goals this year, so I'm going to get a certain percentage of the potential payout, or I met my goals and the company met my goals, or we were above trend. So I'm getting 110% of my potential payout. That's not an uncommon arrangement for executives and non-executives. And oftentimes that still carries forward. But the higher up you go on the ladder, the more likely it is you're going to get paid in non-cash compensation. So I think that's the biggest difference at the executive level, particularly with publicly traded companies, but also can be with private companies, is this introduction of stock compensation.
Mhm.
And that can take a few different forms.
Well, let's put the stock aside for a moment. We'll get into that. The cash bonuses, it comes in a lump sum generally. And what happens with the taxes?
Yeah. So the idea, of course, is the more you make, the more taxes you pay.
Yeah.
So having a good tax planning partner, like your financial planner, can help you plan for those bonuses. So you may get a bonus as an executive that represents a third or a half or even more than your annual salary, depending on the arrangement. So you need to be making sure that taxes are withheld at the right rate. Um, and oftentimes we see with our executive clients, they are under withheld. So if you think about an individual who's earning 500,000 to $1 million a year, and they're withholding 20 to 25% of that for their federal taxes, that's almost assuredly not going to be enough. So they may need to be paying in estimated tax payments in that particular arrangement. And if they're not, they may not only have a surprise at tax filing, which is no fun. No one likes to see a big bill, but they may also owe penalties. And in a world where interest rates have normalized, penalties on unpaid tax amounts have also normalized. So, whereas a few years back, the penalty for late payments was minimal because interest rates were zero in many cases. Now it's material again, so that can cost you dollars, as well as the unpleasant surprise of a big tax bill that you weren't expecting for the previous year.
So you need to do definitely some planning there if you want to, yes, keep the tax man happy, but, yes.
And the other thing with cash compensation, there's kind of a 1A topic really, which is deferred compensation. So we're still talking about cash, but again, this is where the company tries to, for lack of a nicer term, put some claws in you a little bit,
It's
right?
golden handcuffs, baby, golden
Yeah, golden
handcuffs.
handcuffs. So instead of, for example, you are receiving a, let's say you might receive $100,000 bonus. Okay, great. But the company might say, well, actually, this is a deferred compensation bonus, and it's going to pay out in one third increments over the next 3 years. So rather than getting your 100,000 this year, you are incentivized to stick around and get those payments. So I'm going to get $100,000 over the next 3 years, which means I'm going to get 33,000 in 25, 2026, 2027. It might be that I'm stacking these up year over year, so I have multiple years of deferred compensation cash arrangements coming due. So it's you can see where it becomes a lot to keep track of, and it also becomes more important to make sure that you're staying on top of how much taxes you're paying in, because if you stack those up year over year, then you might be in a situation where you're making a lot more money in a few years than now. Again, a good problem. But you want to be on top of that from a tax payment perspective and an estimated tax payment perspective, if that is applicable to your individual situation.
So you should be looking at what you could possibly have coming in every single year, even if it was awarded 2 years ago.
Absolutely. And knowing that thus far in this conversation, we still only talked about part of the picture, right? So we're adding complexity with types of comp, right? Types of cash comp so far. But we haven't even delved into the other arrangement that I mentioned before, which is stock compensation. And of course, there isn't just one type of stock compensation, there's
No,
multiple.
no, that would be too easy.
Right. It'd be too easy. And again, these are all generally in the good problems category, right? You know, the more you earn, the better. But as you climb the ladder, it is more likely that the company you work for wants to optically or in practice tie your pay to the performance of the company. And that's why you'll see, you know, when you look at, let's say, Tim Cook, right? I think his salary has been a dollar forever, right?
Mhm.
So he gets a dollar salary because it's a token amount and he has to get a salary. All of his compensation is stock compensation. And that's the case with many very, very high level executives. But we're not talking about Tim Cooks of the world today. We're talking about folks who still get a salary, still get bonuses, but now they have this new piece of compensation in the form of company stock.
Yes. And this also can get stacked, but we'll talk about that in a little bit. So talk to me, there are different types of stock options you can get.
Exactly. So the most common, we'll kind of break it into, it's really 2/3 types. Uh, Most common today really is some form of restricted stock. So the best example of that is let's go back to our deferred compensation, 3-year arrangement. I got $100,000 bonus. I get it over the next 3 years. With restricted shares, I get $100,000 grant, is what we'll call this, of restricted stock shares. I get $100,000 restricted share grant. It vests over the next 3 years. So what's that mean? It means I become entitled to those shares, in this case, in our example, in equal increments over the next 3-year period. So 2025, 26, and 27 again, same as before. Um, but now it's stock. So what does that mean? Well, today it means nothing other than I should do some planning, right? Because I'm not getting paid anything today. So in 2024, it doesn't impact my taxes. So that's kind of the first thing, is this is a future award. 2025, I'm going to get a third of those shares. And here's the interesting part, is those shares today, let's say I'm getting $100,000 worth, that's the value today. But it's the number of shares, it's not a dollar amount. So the price will drive my future value of those shares up or down. Hopefully the price goes up, and then my one third of 100,000 maybe is worth more. So let's say it's worth 35,000. It's gone up a little bit. I have then $35,000 of compensation, W-2, so it'll get reported on my W-2 next year. And now I have $35,000 of stock that I no longer had, but you are taxed on that full amount. So that's something that is new, right, for me next year as a taxpayer. Oftentimes, I will get the opportunity to take some of those shares and immediately sell them for tax withholding. That probably makes sense because otherwise you got to come out of your bank account or your investment account to pay those taxes. So that's a common arrangement is I'll get the 35,000, I'll withhold the appropriate amount of tax. My shares that I now own will get sold, portion of them to pay those taxes. But then I still have shares and the cost basis of those shares is the value of the stock on the day I receive them.
Right, right. And that's an important point. Why don't you talk a little bit about that?
Yeah. So as an employee, maybe I want to keep those shares. Um, in which case, then I'm not really worried about selling them right away. But then it's as though I just bought shares, right? And that means I'm subject to holding period restrictions, meaning if I sell those shares in a period that's shorter than a year in a day, I'll have a short term capital gain on those shares. If I hold them over that 1 year period, then I'm subject to long term capital gains. So, to the extent I do want to diversify those shares, I need to be watching out for tax implications. So, there's a tax implication for receiving them because that was my comp. There's tax implication potentially for selling them. I could also sell them at a slight loss or any loss and get the same benefit as selling a loss on any other shares I might own. So now you've opened up kind of a second layer of potential tax complexity. Um, at some levels, certain executives are subject to insider trading restrictions, and it might be that you don't get to sell those shares even if you want to, or you can request to sell those shares within certain windows where there's no blackouts. So that's a whole separate level of restrictions and rules. But at a minimum, you should know that I own these shares now. There are consequences of owning these shares. One other consequence could be that these shares are paying a dividend. Well, that's a good consequence, but it's still something to keep track of, right? Because now you have dividend income. You're going to get a 1099 for those shares. So you're going to have to report on your tax return. So if I didn't own shares and now I do, something else to keep an eye on. Make sure you get it included on your tax return.
All right, so that's restricted shares. Did we pretty much cover that?
Yeah, I think we got it.
Okay.
Um, and again, the key there is those are still time based, right? So the company wants you to stick around, and this is a retention tool. It's a bonus, but it's also a tool to keep you in place, keep you in the seat. And you can see what happens is if you keep getting these awards, whether they're cash or stock based year over year, and now you're piling up multiple awards that vest over multiple years, you've been given a bigger incentive to stick around. Then it makes sense, right? They want their good people, their executives to stick around. So this is a very common tool to help encourage that behavior.
What other kind of stock compensation is there?
So I say that restricted shares are probably the biggest form now. Used to be that stock options were the most common form of executive compensation. And what a stock option is at the most basic level is I get the right on a certain day to buy shares at a certain price. So let's pick a basic example and say I'm given the right to buy 1,000 shares and it's $100 today. So that's my grant, that's my award. And like the restricted shares, it usually means that today I can't do anything because there's this thing called this vesting period. Not just the vesting period is simply the time over which I get access to or these awards. Stock options are unique in that you're not you're not betting on directly on the price of the stock as far as total appreciation. You're betting on the difference between the stock price when you got the grant and the current price.
Mhm.
So what that means in practice is there is much more leverage volatility to the value of my stock options too. Because if the stock price goes up from 100 to 110, then I've just made a 10% bump in my potential profit, right? My shares went from 100 to 110, that's a 10% bump. But if you think about the way stock options work, shares going from 100 to 110 means that you're looking at the absolute dollar range of movement, not just the total. So the bump in value of those stock options is much, much higher for every dollar move in price compared to, let's say, restricted shares. The downside is if stock options go below the grant price, then they're worth nothing. So this timing element is in play. And when they vested those, let's say they vested over a 3-year period again, they get a third, a third, a third. Nothing happens until I decide to do something, meaning exercise the shares. So if I exercise the shares, I basically get the number of shares times the spread. The spread is the current price minus the grant price. So that would be a number of shares times 10. That's my profit. That's W-2 income. Gets reported same as a restricted share, goes right on my tax return. So if we think about corporate governance and executives and optics of executive compensation, stock options have gotten, maybe fairly, a little bit of negative press over the years. And the idea there is that with restricted shares, it's time based, right? So
Mhm.
if I, as an executive, get those shares and they vest, it's happening on a calendar date basis. With stock options, despite the existence of blackout periods, so usually there's a window of time before and after corporate earnings where anybody who's subject to insider trading rules is not allowed to transact company shares. Can't buy them, can't sell them, can't exercise stock options, all that stuff. But there's still a lot of time that's outside the blackout windows. So over time, executives have gotten more and more scrutiny with stock options because they have a lot more flexibility on the timing of the exercise of those options. And again, from a corporate governance perspective, it doesn't look as good. So that's why you see companies moving away from stock options as the primary form of executive compensation, stock executive compensation, and more toward restricted shares.
Hmm.
But there's still plenty of companies out there granting stock options. There's still plenty of people who have stock options. And one thing is often the expiration period for exercising options runs 10 years as long as you're employed or in good standing, which usually means employed or retired under the official company rules of retirement. So you often have a long run period where you can consider exercising stock options.
Can you imagine what kind of a stash you could accumulate over 10 years?
Yeah. And that might, one practical outcome of that is, let's think about an executive who's approaching retirement and they're going to go from peak earning years to retired. In many cases, assuming that their comfort with taking the time risk, which is, hey, stocks go up and down, markets go up and down, but probably the year after they retire, most likely is going to be a lower income year and thus potentially a better tax year to exercise a big stash of those options, as you were referring to, Patrice. So again, that comes back to looking at sound tax planning and making sure that, the decisions that are being made not just on what's going to happen this year, but what's going to happen this year and the next couple of years.
Well, then talk to me about performance shares and how they are different.
Yeah. So performance shares, that's kind of the third most common type, and it's becoming more and more common. It's really a variation of restricted shares. The difference is restricted shares historically are time based, right? So I get the award today. However many years in the future, my awards vest. I own the shares. A performance share operates similarly. So there's this time based element, but there's an additional element of performance metrics. And these get kind of wonky in some cases. So they will say, all right, here's your restricted share grant. You get 1,000 shares, but you get them over the next 3 years. By the way, this is just the target number of shares. The actual number of shares is going to be based upon some combination of company performance and your team or individual performance. What that means is it's harder to tax plan because you don't know exactly what the number is going to be, at least not until the award is given, which means during that same year. And it could be higher or lower. So I might not get 333 shares. I might get 200 or I might get 500. So the idea there is, again, we're thinking about corporate governance. It looks better even than saying, well, this is just a time based award. Now we're saying not only is it time based, it's performance based. And, we want to incentivize you to act in a manner that helps the company stock price. Now, can a lot of executives who are not high level executives do that? No, of course not. They can do good work and get rewarded for good work, but it's all part of this idea of let's reward our executives well, but let's also do it in a way that kind of looks better optically to the outside world and to investors.
How can a financial professional help someone in this situation?
Yeah. So when thinking about this type of compensation, there's tax impacts, right? And there's also the long-term savings impact. So we're thinking about taxes today, taxes next year. But then really we're thinking about, all right, well, how does this fit into your long-term savings plan? Because ideally some of this additional income needs to be saved so you can meet your
Mhm.
goals and retire when you want to retire and do the things you want to do while you're still working and do the things you want to do after you're working and meet all those different goals. So incorporating that into individual planning is really important. And, it also, again, I think that tax timing piece of it, particularly with the stock options, can you can be talking about a pretty significant swing in tax brackets potentially, which could save you dollars. And, there's another piece too with all income. If there are clients who are inclined to give to charities, then that opens up a lot of interesting tax planning opportunities. And on top of all this, from the investment perspective, we are thinking, okay, how does it fit into my portfolio? What's the investment perspective? Does it make sense for you to own this many shares, even if it's a good stock? So we have to have that conversation separately, in addition to, okay, well, maybe it doesn't make sense to own that much, but there is potentially a big tax consequence to selling it. So we have to weigh those decisions as part of their entire picture.
And is there a loyalty aspect to that conversation too?
100%. That's guaranteed, right? The stock I own has always done well and it's been the best stock. So why would I sell it? And it's
Mm.
hard to get through the mindset of, well, actually, if a stock has done way better than the market, then that's precisely the reason to sell it because you beat the odds. You took the best way to make the most money and lose the most money is own one stock, right? That's that's how you can make and lose the most money with investing. So most of our clients don't want that risk, but they may well be taking it if they work for a company for a long time, chances and done well, chances are they probably own a chunk of company stock through either executive compensation plans, through stock purchase plans, or some combination thereof. So it's tough to part with something that's treated you well. In most cases, it's not parting with the whole thing or even most of the thing. It's parting with some of it over time. One way to part with it is to give it away to charity, and I think that helps people feel better about making the break, so to speak. Is well, if I know it's going to organizations that I support, and by the way, when I give away that stock, I don't pay tax on it. That makes it an easier conversation.
Well, Joe, some really good points here, and I'm sure some people are starting to think about what they have, what they could get in the next couple of years. So how can someone reach you or anyone else at Foster& and Motley if they'd like to look into this a little bit more?
Sure. You can always find us online, www.fosterandmotley.com, fosterandmotley.com, or you can reach out to us toll free, 1-800-532-2962.
All right. And listeners, make the most of the executive compensation you've earned or you plan to earn, and let the folks at Foster& and Motley help you. Follow this podcast so you know when the new shows are ready for you. And of course, please share with others. I'm Patrice Sikora, and thanks for being with us.